Thanks, Eric. Yes, 10 days ago, 12 days ago, I was so excited to come to PDAC. Gold was looking so strong. The fundamentals were coming through. Everything was doing what it needed to do. And then we had last week, culminating with a day on Friday I was glad I was in the air yesterday. And then I landed and saw the gold price and just had a bit of a moment. And then, then you carry on. So, this is the title of my talk. We obviously have chaos going on right now. It is happening within a fundamental setup for gold that is very positive. And I think if you're here, you probably are at least reasonably aligned with that stance. So I wanted to start by going through the fundamentals for gold because they haven't changed. Even if gold lost $80 at one point yesterday, it was down almost 5%, which was a bit of a shocking number. The fundamentals are what they are. And there's lots of reason to believe that the chaos will only help those fundamentals. So let's understand what they are, and then we can dive a bit into the chaos. I am not an economist, and therefore there are others here who are probably better suited to try and explain what's going on with the world right now. I certainly have ideas, as I'm sure we all do. So gold, I would say, was just getting started. If you just look back at 2019 as a capture of what we've been going through, it gained almost 20% last year. That is a very significant move and is a standout amongst asset classes. The gold index was up 50%, 49%, which was its best since that crazy run that we had at the beginning of 2016 that started this bull market. And prior to that, its best annual performance in more than 2 decades. And of course, the M&A number was immense because it included some very sizable deals. But still, these things are all outline a market that was getting a lot of interest, that was doing very well. And it was doing so for very fundamental reasons that, as I just said, are really here to stay. So I'm going to go through those reasons to some extent right now. First of all, patterns are called such because they are repeatable. And when you look at gold bull markets, they are definitely patterns. They usually gain, the gold price itself usually more than doubles in a bull market, and it is only halfway there now, so there's certainly room for more in the price of gold. And when you look at gold stocks, there's lots more room. If you look at gold bull markets, they average about 50 months. And the gains are usually about 190%. Instead, we're looking at about 8%. And yes, we've had most of the duration so far, but we haven't had very much of the fun yet. So either this gold bull market is completely different than all that have come before it, or there's a lot of upside left based on the patterns. Why should you have faith that we are in a gold bull market? Because of real rates, right? So the primary driver for gold is negative real rates. If you look back over the last 50 years, you could say, if you just take an average, gold has gained 4.5% annually for 50 years. But it certainly hasn't done that on a consistent step-by-step basis. It has not gained 4.5% adjusted for inflation each year. Instead, it steps down whenever real rates are positive, and it gains in an outsized way when real rates are at least zero, if not negative. That's how gold moves. It jumps when real rates are negative. And that's what this chart shows. The most important factor, I think, right now is that rate help for gold is here to stay. We are not, can you imagine the central bank raising interest rates right now? Like this week, let alone even 2 weeks ago, you probably couldn't imagine it, right? So we're not in an environment where the central bank is about to start aggressively hiking interest rates. So from just that standpoint alone, rate hike is here to stay. Looking more broadly around the globe, of course, most economies have more negative rates than we do right now, real rates, than America does right now. And in the face of coronavirus, there's lots of talk about whether we have another interest rate cut coming. Will the Fed cut rates in March? Potentially. If you look at bets, the bets have certainly increased. If not March, then maybe April. Who knows? Did the markets turn up at the end of the day on Friday because people are wondering about a rate cut, like a sudden rate cut, or at least an injection of liquidity on Monday? It's definitely a possibility. But in general, we're in a situation where central banks are not about to start raising rates. That's not going to happen. Big picture-wise, also, debts, both corporate and government, are very big. That's another argument against raising rates. It just makes this debt load that's already a huge burden, even more difficult to manage. And then the coronavirus chaos actually has the potential to encourage inflation, which did step up in the last several months, and it could certainly encourage inflation. Japan has already given out helicopter money. It put $1,200 into residents' bank accounts. That is inflation in action right there. And the disruption to supply chains has the potential to lift prices. That's also inflation. Is it transient? Sure, but in the moment, there's certainly reason to believe that we could get inflation help on the real rates front from this chaos. So the point is that low and negative interest rates are the reality for the next while. And that always pushes gold higher. So that's the most important fundamental setup for gold. That has not changed, and if anything has improved with this chaos. Amongst that, we also have, gold obviously gets buying because negative real rates mean that it provides return when bonds are not providing that. And on top of that, the bond market is sort of largely a mess right now. Large pools of money have always bought bonds for yield. The 10-year is currently giving you 1.2%. That's like nothing. And if you adjust for inflation, it's actually taking money away from you. So the whole bond market approach for these large pools of low-risk money is not working right now. They can buy bonds for price, which is a completely different game, and it's a game that they've been forced to play for quite some time now because that's what bonds have been giving. They've been giving price, not yield. But in general, we have a huge pool of money, a huge pool of bonds of debt that carries negative yield right now. The rest pay very little. The safe haven trade, what you do to diversify risk, is different this time because the bond market is so backwards. And I love this chart. I've used it in quite a few presentations over the last little while, but I love the correlation between the market value of global negative yielding bonds and gold. Like, if you want to see correlation, that to me is correlation. That is about as tight as it gets. And yes, gold tracks the market value of global negative yielding bonds, because if you can't get yield from bonds, then you need to put your safe money somewhere else. Okay, so the dollar has gained significantly in the last few weeks out of fear buying. That's a normal move. Broadly speaking, though, there is definitely reason to believe that the US dollar in the sort of medium term is going to face some headwinds. The repo operation is the best example of why that is. Again, the US keeps needing more debt to support its spending. The repo operations are happening because it is becoming harder to find buyers for US debt. In the last week, that's been different, but prior to the last week, it has been harder and harder to find buyers for U.S. debt, and that leaves U.S. primary market dealers holding the bag. The repo injections are the central bank supporting those primary market dealers who have to hold that bag. That's what they signed up for by becoming primary market dealers. And what is that? At the end of the day, that is the Fed monetizing its deficit because there's a lack of buyers for bonds. The only way to fix that situation, big picture wise, is for the US dollar to weaken. The other two solutions are to really cut spending. We'll see how that goes, or for rates to rise significantly, right? Neither of those are likely, so big picture wise, the answer to that is a weaker US dollar. Clearly, that isn't what's happening in this moment, but if you take a step back, that is a requirement in this scenario. Okay, so that's the setup for gold. That is why I think gold will perform. Instead, yesterday it fell 5% at one point. So, well, that was fairly annoying for sure. Isn't it supposed to perform in times like this? Sure. But, and I'm sure you will hear the annoying phrase baby with the bathwater more often than you want to today and tomorrow, but that is, in my estimation, entirely what's happening. I think a really great example is Great Bear, a company that's represented here today, a company that has been obviously a standout performer in the gold market in the last few years. It lost $100 million in market cap in the last few days. It's traded, I don't know what the price, $6.30 or something it's trading at, down from $9 last week. That's a huge change. Why is it getting sold? Not because people have changed their estimation of what they've discovered. They still believe whatever they believe about what's in the ground there and what will be delineated over the next year as this massive drill program advances. So that hasn't changed. And I would bet that people's overall perspective on gold hasn't changed dramatically because of the fundamental setup that I just went through. But instead, people are seeing their portfolios bleeding red and they want to salvage what's there. So something that's up, whatever percent it's up, depending on your entry point, is a good option to sell. And they're probably seeing buying opportunities just down the road, right? And so they want to have cash on hand for when they decide to re-enter. So what do you do if you need to raise cash when everything's bleeding? Well, at least you sell the things that are still giving you, that are still up in your portfolio. So I think Great Bear is a good example of it. Great Bear is a good example of the fact that gold and gold stocks get sold alongside everything else. Now, gold the metal may not have had such a sharp reaction years ago, but now a lot of gold is traded just like a stock, right? It's traded as the GLD, it's traded as an ETF. So the perception is that you just sell it the way that you would sell anything else because it's up. So just like Great Bear, you sell it because it's something that you can take cash back from in the midst of all of this chaos. And it's investors making those individual decisions. It's funds facing redemptions in the face of all this chaos. It's anybody who wants to reduce risk in the moment. If you just call your broker and say, sell everything that's high risk, that includes all mining stocks. It doesn't matter what gold's doing. Mining stocks are high risk, so they get sold. So that is the explanation for what's going on right now. How bad is this all going to get? I don't know. I wish I did. I mean, like I say, the S&P turned up at the end of the day on Friday. How significant is that? We shall see when things open on Monday. Gold rebounded from its worst 5% decline yesterday to close only 3.5% down. What does that mean? I don't know. Will the central bank step in with action? I think they'll probably wait to see how things open on Monday, but they probably are primed with actions if they decide they need to announce those on Monday. COVID-19 is disrupting global supply chains. There's absolutely no doubt about that. China growth is decimated in the short term. I mean, if you just look at pictures of the streets of Shanghai right now, then you know that that's a reality. If you look at the number of people who can't get back to their places of work, even if those places of work were open, China growth is very threatened and will be cut in half, something like that, in the first quarter. These are short-term effects for sure. Contagion to Europe, very real. Germany, for instance, is very exposed to China. It's a huge market for the German auto industry. So these effects, it's not a gentle ripple effect. These effects are real and they are happening, and global growth is threatened in the moment. How dramatic is it? Does it justify what's going on in U.S. stocks? Pundits are arguing left, right, and center on this point. It seems like what I see is there's been a tenuous balance in the U.S. stock market. There's been a lot of, if you looked at fund flows last year, money left the stock market, broadly speaking, and that's because of a rotation out of a sense of wanting to protect against the risk that the bull market will end at some point, that all of the central bank liquidity and ultra-low interest rates that have been fueling this will come home to roost at some point. Rotating into gold, that's why gold gained 18% last year. Awareness of risk has been rising in the markets for the last little while. So in that sense, it's not surprising to see a reaction to this event of the scale that we're seeing. Is it an overreaction? I'm not sure. It probably is, but that doesn't mean that things won't get worse at this point. Black swans happen because of the setup, not because of the event themselves. They happen because a catalyst occurs within a setup that is tenuous. So what are the paths right here? Well, either things get worse or they correct. Doesn't take a genius to make that statement. what happens to gold in those two scenarios? Well, if the correction eases from this point, then gold starts to go back up from where it is right now, and investors already sort of quickly start rotating into gold stocks to lever that rising gold price that everybody knows is a haven in these sorts of situations. If that's the scenario, then this dip in gold miners, gold juniors, is a limited event, and therefore you need to be ready to deploy capital into the dip fairly soon. The other option, of course, is that broadly speaking, things get worse from here. If they do, the correction in gold and gold stocks will continue because gold gets sold as a stock these days. Everybody's selling things that carry any risk. Everybody's selling anything that has gains in it. Gold, if the GDX was, or if the TSX Gold Index was up 50% last year, then gold stocks are among those in the portfolio that are still in the green for investors broadly speaking, and therefore can be sold to redeem cash. Either way, what matters is that the rebound, I think, is a guarantee in gold. Where we bottom is the unknown. The rebound, however, I think is a guarantee because of the fundamental setup that I just went through. The negative real rate, bond market a mess, awareness of risk setup, gold will rebound strongly from this. And so I put in there, the GDX gained 230% in 2 years following the great financial crisis. So that's just the biggest caps in the sector doing incredibly well in a short time frame, following a major dip. Okay, so what do we do about all of this right now? Gold makes sense. So what to do depends primarily on how much of a trader you are, but I think what you need to think about is whether you have cash to deploy into opportunities, because I think opportunities will present. Now, I put that in the future tense because clearly Great Bear is available at $6.30 right now. That's an opportunity. Will it be cheaper on Tuesday? That's what I don't know yet. But once we get some sort of comfort that gold has stabilized and that the worst is over for the gold space, then I think you will want to be able to deploy into opportunities. Now, hopefully, it certainly feels a few days late to be telling you to sell things so that you have cash available. But this conference is happening when it's happening. I made that comment in my letter in the middle of last week. There's no point holding on to a stock because it was worth more 4 days ago if you think it's going to be worth less, or if you're worried that it's going to be worth less, and you could sell it to have money to rotate into opportunities that I think are going to be quite exciting in the next little while. So just assess each stock that you have in your gold portfolio as a screen for which have the worst near-term challenges. Those can be complete lack of news. Those can be the need to finance. Those can be a free trade date for a financing that happened 3 months ago at a lower price than the stock is currently trading at. So reduce exposure to those that have the highest near-term risk. Reduce exposure just means sell and therefore accumulate some capital. And then be prepared with a list of the stocks that you want to buy. Now, those may be of a slightly different ilk than the ones that I just described, because the stocks that you probably want to buy for leverage to the bounce are those that provide the greatest leverage to gold. So those are miners, those are royalty companies, and those are stocks with large resources. Or, Great Bear is a bit of its own beast. It doesn't actually have a defined resource, but it has a lot of resource potential and a lot of excitement around it, right? So be prepared with a list of stocks that you want to buy into, that you're comfortable will give good leverage to gold when the V-shaped bounce happens once the chaos subsides. I don't know what that time frame is. I'm not going to pretend that I do, but I am confident that it will happen. And so I just want you to be prepared for that in whatever form that looks like for you. A list of stocks to buy, potentially selling so you have cash to put into those, and just paying attention for when that opportunity presents. That is all I can come up with to say today. So I will leave it there. These are the products that I produce. I have a weekly newsletter that tracks the majority of my portfolio, which is medium to high risk. exploration and development stocks in the mining sector. I have a monthly newsletter that's designed for investors who are not as familiar with the mining space but see opportunity and therefore want to learn some and be exposed to low risk investment ideas. I have a premium service for those who are interested in having access to the financings that I participate in. And just like all the newsletter writers who are present at this event, I don't take money from companies. I just write about what I'm buying and selling. And with that, I will take my leave of the podium and ask John Budrowski.